started, if you want to share a little bit about yourself and about Juno, and then we're going to move into tonight's topic about loans.
Awesome. Debbie, thank you so much for having me, having Juno here. I will do my best to step in for Chris. Chris is the master at this webinar. He's done this for a few years now, and he's just phenomenal at it. But I am well thought on the topic. I'm Chris's co-founder. We started the company together, and we'll walk through this material he has so diligently put together. So quick note on Juno, actually. So actually, I'll go to this slide right here. So I'm not Chris, I'm Nikhil. I went to University of Illinois, Urbana-Champaign, did my aerospace engineering there, had a lot of fun. Went to Boeing, which is not such a hot company these days in the news, so don't ask me about what's happening there. I joined Chris at Harvard Business School and co-founded Juno with him. So you might be wondering, what is Juno in all of this? And I'll go quickly through it now, and I'll actually repeat it at the end just so that we have an understanding of Juno. Juno started as an effort back in 2018 to get lower rates for student loans. Really, for me and my classmates, there were a few hundred of us, and we said, hey, can we go to the banks and say, okay, we all are willing to get a loan from here, but we need better rates, right? And we negotiated that. It was a huge success, and we've grown that since then to thousands of programs across the country, including internationally. Actually, some colleges in France, for example, or the UK, we are present there as well. And to date, I believe we just in February or March this year, we crossed over $1 billion of student loans. So very exciting milestones, and I'll talk about exactly what Juno does a little bit later. Today, what I want to focus on is first negotiating your financial aid award letter. At this stage, July 9th, I would expect a lot of folks have received their financial aid award letter. If you haven't received it yet, you're probably pretty close to receiving it. I know this year there have been some delays at a number of universities, so it's not the typical calendar year cycle we're seeing, but it shouldn't be very far away.
So, sorry, Nikhil, to interrupt. I'd also be curious if people want to share if anybody has gotten their bill from the college yet, because that is also sometimes, and I'm just curious, I don't know this year because of everything that has happened with financial aid and FAFSA, if there's a delay in sending that information out as well. So it usually gets sent around this time, but I'm just curious if people have actually gotten that yet. Okay, it sounds like, yeah, it's just happening now. Like some people, yeah. Yesterday, right. Somebody said it's supposed to be coming the 15th. Somebody said the August 1st. So yeah, this is the next few weeks is when things really happen. Okay, sorry to interrupt.
No, thank you. And it's usually also the prompt for people to like spring into action. You know, you sort of see that financial aid award letter, you see the bill, and you're like, let me figure this out. I should probably go into slideshow mode, right?
Yes.
So we are right in the thick of receiving these financial aid award letters. So what's important is not just receiving it, but also responding to it, which is a critical step we'll talk about in a few seconds. The other part, and we'll spend a good amount of time in this, is understanding the various options for undergraduate student loans. Not graduate, that's a completely different topic, completely different ballgame. If you have a graduate student, shoot us an email. Happy to help you understand that. But this discussion is all about undergraduates. And then finally, we'll talk about how to get the lowest rates. We won't leave you hanging on Q&A. Whenever we do these, it's not uncommon. I measured the ratio last time. We had a 1:1 ratio of questions. So we have 118 people right now. We had 118 questions, right? If the same ratio holds. When we did a similar version of this webinar. We don't want to leave you hanging. Ask away your questions in the chat, and we'll try our best to answer them either in the chat, on the, aloud. Debbie's going to help me out a little bit over here. Sorry, Debbie, I'm putting you on the spot. And we want to get to your questions. If we don't get to your questions, we'll do some more Q&A at the end, and we will also be available to you through one-on-one sessions, through email. Just we want to make sure your questions get answered. Okay. It's a very big part of making sure you have all the information you need to make the right decisions. All right. So you just got your award letter. The big mental shift I would encourage everyone to make is to think of it as a first draft. Okay, the typical award letter, it comes in various formats, but the typical one, it'll have a number at the top. It's usually the cost of attendance, right? And I say these words with a certain meaning, which is the cost of attendance is this number that the school puts together, and it's their estimate for what that academic year is going to cost. It is inclusive of tuition and fees, of course, but it also includes an estimate for living expenses like room and board if you're staying in the dorms, or rent if you're staying off campus, food, some personal items, a laptop, things like that, right? So that total number is the cost of attendance. And this number is useful in various discussions. It's going to be useful here in the award letter discussion, but even in the student loans, it becomes critical because it determines how much you can borrow. So we see this award letter, it's going to have the cost of attendance at the top. And then a very important section, which may or may not be present in your award letter, is grants, right? And they could be, it could be phrased in different ways. It could be a need-based aid, it could be merit-based aid, or it could be just grants, right? And this is money, when someone uses the word grants, they're talking about money that does not have to be paid back, right? And you want to try and maximize this, of course. So this is where we suggest thinking about the first financial aid award letter you get as a first draft, and then replying to the school and asking for more aid politely, right? We also suggest thinking about, what you can use within this letter, right? So, for example, if you have admission at a different program and that program is offering you some aid, you want to mention this politely in the letter to the school you'd like to go to and say, hey, can you help make my decision easier, and share the details of the other offers you have, right? And this is going to help the financial aid officers decide in your favor. The reason this tends to work is financial aid officers are often thinking, hey, I want to make sure the number of offers I send out, most of those are actually accepted and those students come to this program, right? They've already fallen in love with the idea of having your student come to their program. So you're sort of leveraging that to get them to accept your student. And schools are budgeting for this. Not all schools, but many schools are budgeting for this. So they already plan to give this aid out. And if you're not asking, the person next to you is asking, and they're going to get that aid. So it's in your best interest to make a polite request when you receive that financial aid award letter. Debbie, any thoughts to add to
that? Sorry, no, I think you covered it. I was actually answering somebody's question, but
yeah, I'm seeing they're flying off the shelf there. Okay, so from a more logistical standpoint, you get this award letter, and you want to typically send an email to the financial aid office to ask about what's the best way to do this. Some have a structured process, some it's, the email is the official request, and then you submit the appeal. This is something new this year where I'm trying to remember, I think it might be from the Biden administration's decisions, that there is a sort of a requirement for the schools to be able to look at this and understand the appeal when it comes to what's mentioned here as far as adjusting the cost of attendance and the data used to calculate the student aid index, right? This is part of what normally gets processed through your FAFSA, right? Is something that the school is now able to appeal on a case-by-case basis, and they're required to have a process to do this. So
Yeah, it was part of the FAFSA Simplification Act, which had these changes to the FAFSA calculations and everything that happened this year. So yes, part of that, which is, I think, a good thing, although there's so many not so good things that happened, was that schools were required to have and post their appeals process. And not every school in the past allowed you to have this process.
got it. And I would add a clarification of there are plenty of grants that come through the school's financial aid office unrelated to the federal programs. So those may not be sort of such a published process, right? So that means if your financial aid award letter has grants that are not federal, you can still reply to that and say, hey, can I get some more, right? Okay, cool. So what you need to file an appeal, draft a formal appeal letter. This is also where you might politely include anything and then add the supporting documents to substantiate anything you've put into your appeal letter. And finally, the types of documents could include something like W-2, pay stubs, bank statements. A lot of times, nuances are things to consider, right? Like, for example, one of the big ones we see is dependents, right? And someone may not be officially independent, for example, on a tax return, but you may want to explain that, hey, so-and-so is actually a dependent and they're staying with me and, I'm paying for their sustenance, etc. Those kind of things are good information to include that you may not have been able to include. And this is very important, both for school-based, need-based programs and the federal programs as well. All right. Yeah, so one thing we do suggest is think about where you're asking for that aid. Usually there's one program that, you've already decided that this is the program you'll be attending and you want to optimize your request towards that program. And like I said, it's good to leverage other admission offers and other financial aid offers that you may have received, as it could help you convince the school that you deserve that aid. And don't be afraid to ask. You've already been accepted. Make a polite ask. You're not risking them rescinding admission by making a polite ask. Okay. We do have a link to this template. More recently, if you are comfortable using ChatGPT, I have been encouraging folks to, put out your specifics in a conversation with ChatGPT and ask ChatGPT to draft this letter. It's surprisingly good at doing that. If you're not comfortable with ChatGPT, you can totally skip it and modify one of the templates over here. But it's a useful tool, especially if you have a complicated situation that you want to succinctly explain to the financial aid office. Awesome. So I'll pause there for a second. I see a question over here from Carol. Isn't it too late to be asking for more aid? We are getting to the wire for finding loans.
No.
Sorry?
No, sorry, I just muted somebody.
Okay. I don't think any time is too late, right? There are two types of requests, right? One is sort of the yield protection request, which, yes, it's getting late in the season for those types of requests. But the need-based request is not really, I wouldn't say any point of time is too late, right? You really want to be making those requests regardless of, you feeling like, oh, all the admission selection kind of stuff is over, right? The yield protection stuff, yes, it feels a little bit late.
So yeah, let me just kind of add a little bit to what Nikhil just said. Throughout the whole year, if your financial situation changes, you can always appeal based on whatever the change was that it impacted your financial situation. Change in job that decreased your salary potentially, or unfortunately if you were laid off, or if there were medical issues that came out of the blue. So that's year round. If you've got a change in financial circumstances, you can appeal. I agree in terms of like the merit situation. It's probably like dying down, or you're kind of losing your opportunity. Except I will say, and I haven't seen this yet, but I wouldn't be surprised if it starts happening. I think it was about 2 years ago that things changed in college admissions, and after May 1st, colleges are allowed to still market to students who may have turned them down, or maybe never even applied to begin with. So if your student gets kind of like that counter marketing or that counter offer from another school, and I've seen it happen. I wouldn't be surprised if it starts happening more now because of just what's happening in the school consolidation of campuses these days. If that happens, and I would absolutely use that as leverage and bring it back up to the school, because at that point they might have thought, oh well, hey, junior's coming, but now they might have been counting on that for their revenue, but if you've got another offer, then let them counter.
Yeah, and it's hard for them too, right? Like when a school loses a student late in the cycle, they need to fill that seat, right? They're not gonna want that seat to go empty. So yes, it's less common, but perhaps it's, and I'm guessing here, I don't have any data to back this up, but if I'm in the school's shoes, I also have less time to fill that seat. So I really don't want you to leave. Yeah. All right, cool. Let's jump into undergraduate student loans. This is sort of one of those topics where there's a variety of options. We're going to talk about them. And I'm also going to talk through this in a way where we think of a decision tree. So we are thinking through, okay, here's a few simple questions I can answer and use that to decide what is the best option or options very commonly for my family, right? At a high level, we can think of undergraduate student loan options as what we call the direct loans or the Stafford loans. These are fabulous. This is a fabulous product offered by the federal loan. We'll get into the details of that. But the main challenge with this option is a very low borrowing cap. Often people need more than what's offered through the direct Stafford loan. And that's where the Parent Plus loans come in from a federal loan option to fill in that gap up to the cost of attendance. And then the private loan sits as an alternative to that Parent Plus loan, again, up to the cost of attendance. But there are some trade-offs that are really important to understand before you make your decisions on which one is the best. So let's dive into it. What we look at for each of these loan products is what's the origination fee. An origination fee is something that's charged right when the loan gets dispersed. And it's not something you may pay out of your pocket to the lender, but it gets tacked on to the loan. The second thing we look at is the interest rate. Most people are familiar with this concept. It's sort of the recurring charge that gets tacked on for the amount of money that's outstanding on the loan. We'll talk about how much you can borrow. I already hinted to that on the first loan, and the rate type, whether it can change over time or whether it stays fixed. We'll also talk about certain non-financial topics which often drive some of these decisions. Is a qualification, right? Will I even get this loan? Whose name the loan is in? For some families, that's a little bit more important. than other families. Like some families, they're just like, I don't care whose name it is in. It's a family loan, and whereas other families care a little bit more about, whose name it is in, whose credit report it's on, and the sort of responsibility as it falls legally. We'll talk about when payments begin and how you can adjust that for various loans. And finally, one of the critical things to think about is what happens if you have a hardship. The typical hardship we are referring to is something like a loss of job or other means where you feel you're not in a position to continue making payments on the loan. So we'll talk about all of these. Okay. So the federal direct loans or the Stafford loans, great product. It has an origination fee. All federal loans have origination fee. This is a relatively small origination fee of 1.057%. The interest rate for this loan for this year, right, for 2024, fall 2024 and spring 2025 is 6.53%. This is going to change on a yearly basis. So it's not something we know what is going to be for next year, but for this year, it's 6.53%. What I'll add is student loans are really an annual process, right? There's no way to really figure out what we're going to do in summer 2025 for fall 2025 and spring 2026. There's no information. You don't know the federal loan rates. Private lenders are not going to give you a quote. There are some banks that kind of hint at something for the future. There's one bank that does that. But other than that, there's really no way to figure out where you're getting the financing from for future years. So I'm going to scope this discussion into 1 year at a time. Really the downside of this loan is the borrowing cap. The maximum you can get through this program is $5,500 for an incoming freshman. I'll show you the limits for other years, but I assume most people here have an incoming freshman, and they're gonna be able to borrow $5,500 at most. And there's some caveats around that we'll talk about in a second. The interest rate is a fixed interest rate, so it doesn't change over the life of the loan. It's 6.53%. It's staying 6.53% for 10 years. And really, it's more like 14 years because that 10-year clock starts 6 months after graduation. It does not require a credit check. There's certain criteria to ensure you qualify for the loan, but it's not like, oh, you need to have the student needs to have a certain FICO score or anything like that. It does show up on the child's credit report, and there's no payments required while the child is in school. There's no payments required for 6 months after graduation, and that's when the standard repayment plan would have them paying it off in equal monthly payments for 10 years after 6 months after graduation. There are a number of protections for this loans. It's really the most widely protected loan. So for example, if the student graduated, they didn't have income, they could apply for certain repayment plans that could cut their monthly required payment to as low as $0, right? So no real monthly payment required if they are in a challenging financial situation. Of course, if they're making good money, then they're usually on the standard repayment plan, which requires monthly payments and paying off the loan in 10 years. This year, 6.53% feels a touch high for me to say, oh, this is just absolutely the only loan that you should consider first. It's still very likely, call it 90%, right? For 90% of folks, this is going to be the best option that's available.
Well,
there might be
Nikhil, the reason why this is still an important loan for students and families to consider is is likely the only loan that your student can get without a cosigner. So you as a family, and I've seen some rates from people, might be able to get a lower rate from a private lender. It's not going to be easy. I don't, because in this environment, but I have seen a few people get it, and they obviously must have had excellent credit score, and I don't know what their debt to income ratio was, but So, but you won't be able to get any loan, and I'm probably being a little too strong with that, but it's probably likely. Any loan where your student can be the only borrower and no cosigner. And this is the only loan that's available with those factors.
Yeah, 100, yeah, 99% true, right? Like it's very rare to see a student get a loan without a cosigner at any rate close to this. Like I'm like double of this is probably the starting point for a student without a cosigner if they even get approved. So yes, for loan without a cosigner, hands down. I have a fine print over here, and I also see a related question. So I'm gonna try to address that. So what information I have here is for, well, it applies to direct unsubsidized or direct subsidized loans. Your student might be able to, keyword might, right? Depends on the FAFSA application, might qualify for subsidized loans. If you qualify for subsidized loan, the government pays the interest while the student is in school. If you don't qualify for the subsidized loan and you're only getting the unsubsidized loan, then interest is going to start accruing as the loan is dispersed, right? So as the loan gets dispersed in the fall semester, roughly half the money would get dispersed and interest would start accruing on half the funds. And then in the spring semester, when the remaining funds get dispersed, interest is now accruing on the whole amount. However, if you qualify for subsidized loans, then the government is essentially paying that interest for you. Now, and you can also end up with a mix, right? Where they say, oh, you're eligible for X dollars under the subsidized program, and you can borrow up to 5,500 with the unsubsidized program. So I saw a question about, someone having like roughly $1,200. I'm suspecting that they're offering subsidized loans of 1,200 and up to 5,500 in unsubsidized, but more than happy to take a question like that and review the offer letter in an email. Okay. I was hinting at some flexibility on how much you can borrow, and this is what it comes down to. So most students are going to fall in this left column of dependent students. And in that situation, an incoming freshman can borrow 5,500, a sophomore can borrow 6,500, a junior can borrow 7,500, and so forth. I actually was an independent student because my parents were not US citizens and my parents were not in the country. And for sort of a variety of reasons, I ended up qualifying as, really the reason I qualified was because my parent was denied a Parent Plus loan. And so I was able to get independent students. So it does happen, but most students are going to be getting these limits reflected in the left column, right? So 5,500 for incoming freshmen on this particular loan. Now, if you're in a unique situation where you meet one of these criteria, you would be considered an independent student, and then the limits on the right would apply. Okay. I don't think too much more to be said there. If there are questions about this, happy to chat about those. So
yeah. Can I go back? I just want to mention a few things about these loans. Is that once the freshman year, let's as an example, has passed, if your student hasn't taken the 5,500, they cannot go back in time if you decide you need that money in sophomore year or junior year. So that's just something to think about. It's kind of available for that particular year, but if you choose not to take it, you can't add it to future years.
Use it or lose it. Yep.
Yes. So that's important to consider. That's why we really encourage people, and I know it's hard, but to try and make a plan for 4 years about how you're going to pay for college, and just estimate what those tuition increases are going to be. I mean, at a minimum, I would put in 5%, 6%, and just kind of estimate out what that total the college costs are going to be in sophomore, junior, senior year, and kind of even though maybe you can cover it now, are you going to need to borrow later? And because you're going to need to borrow later, maybe you still might want your student to take out the federal loans this year. So just think it through. The other thing I will say, though, is if you choose not to take that money out at the beginning of the year, you have the whole year to take it out. So you could decide, in January, things changed and you didn't take it out in September, you can go back and get the full amount. So, but just you can only take it, during that academic year. And then the last comment is that you can take it out, and maybe because you're not quite sure how, the year's going to go, or you're not quite sure if you're, going to need it in sophomore and, junior, senior year, and you can pay it off. So that's another option. So just wanted to kind of put out all the different ways of thinking about it.
Absolutely. That is great advice, because it is not uncommon for me to get an email in the middle of the year or sometimes in the sophomore, junior year saying, I need more funds. Where do I get it from? Right. And, the unfortunate part is at that point it's too late. So if you're financially planning for 4 years, you are, and being conservative in that, knowing that, look, when you take these loans, you're going to see a number that says interest over the next 14 years, 13 years, and it's going to be a big number, right? It's not uncommon to see a number roughly half the loan amount as just interest. I'm not telling that to scare you, but to help you think through optionality, right? That assumes you're making the minimum payments on the loan for the life of the loan. None of the loans we are discussing today have prepayment penalties. What that means is at any point of time, you feel you don't need that money anymore. You can log into the lender's portal or the servicing website and pay off that loan, including the interest that's accrued up to that point. And these can be partial payments or full payments. It's kind of up to you. But there are no prepayment penalties on the federal loans. There are no prepayment penalties on any private loan that Juno is going to put in front of you. And really in the industry that we don't see prepayment penalties these days. And if you did see it, it's kind of weird. And I would be very cautious before, signing with a lender that has a prepayment penalty in this day and age. Okay. Now, so from a decision-making tree, right? I said, I'm going to try to make this a little bit easier. As an incoming freshman, do I need more than 5,500 for this year? No? Great. Move forward with the federal direct loans. If you can get the subsidized version, great. If you can't get the subsidized version, even the unsubsidized version is fabulous. Very likely your journey is done here. Now most people are going to fall into this right bucket where they say, I need a little bit more, right? And in that situation, we need to think a little bit more about what are our options. Even if you're in the right bucket, you're still going to say, max out this federal direct loan option, right? Because it is hands down the best option that kind of exists, right? Okay. So the Parent Plus loan. So what's the Parent Plus loan? It's the federal loan option beyond what the student gets directly in this name. Kind of like the name suggests, this loan is only in the name of the parent. The student is nowhere to be seen, on this loan. It's not going to show up on the credit report. They're not legally responsible for paying it back, even if you have an arrangement within the family to help the student understand that they are responsible for paying it back. Legally, they have no obligation to pay this loan back. And just to clarify, the parent still does have the obligation to pay this loan back. It's a very heavy origination fee, 4.228%. To put that in context, right? If you're borrowing for every $100 you're borrowing, there's additional $4 or so that gets stacked on to the loan amount. So let's say $100 reaches the school, your loan amount on day one is going to be $104 and 22 cents, right? So, and then interest is going to continue accruing on that $104 as opposed to just the $100. So it's a very significant origination fee. The interest rate is also substantially higher than the direct program. It's 9.08% this year for fall 2024 and spring 2025. The good news is there's no borrowing cap per se on this loan. The maximum you can borrow is up to that cost of attendance number minus other aid you've received, right? So if you've received some grants, you're going to subtract, you're going to take the cost of attendance minus any grants you've received, minus the federal direct loan that you've taken, and then the rest of the funds can be borrowed through the Parent Plus loan. The interest rate is fixed, it doesn't change. There is no credit check again, but there are some requirements to qualify for this. I'll share that with you on the next page. Now, by default, you start making payments on these loans 60 days after the loan is dispersed. So let's say in September, the loan gets dispersed. In November, you might be making a payment on this loan. That said, many parents will opt to defer these loans. So you can choose to say, hey, I don't want to start making these payments this quickly. I want to defer until 6 months after graduation. And that's an option you can choose. If you don't recall whether you made that choice or not, you can reach out to the financial aid office and they can provide guidance on how to make that choice. And this is a federal loan program. There are some hardship protection options that come built into the Parent Plus loan program. There is also, sometimes you can do a consolidation loan to combine a few of your Parent Plus loans of each year. And then that may unlock certain hardship protections as well. So I'm just thinking of the combined, as is loan, as well as a consolidated loan. Each of those have some hardship protection. It's not as good as the student version of it, but it's still quite strong, right? So, okay, so that's the Parent Plus loan. And really, when we think about eligibility and how do you get the Parent Plus loan, it's part of the FAFSA process. There's no like hard cutoff on the credit score. However, they do look to make sure, you don't have any bankruptcies, you don't have a lot of delinquent debt, tax liens, wage garnishment, things like this, right? So if this happens, if any of this has happened, then you would be denied the Parent Plus loan. However, the student would then be able to borrow a larger amount to the federal direct loan, right? So that's just something to think about. It's not a choice you are actively making, right? But depending on your situation, the Parent Plus loan may not be accessible. What I'll also add is if you are in this situation, it's common that the private loans are also not a real option. So in that case, you're sort of limited in terms of how much you can borrow to what's available directly to the student. Okay. So private loans, right? Like I mentioned, we think of private loans often as an alternative to the Parent Plus, right? We maximize our direct loan, but we think that's, the best loan we can get in the market. And then we say, okay, let me look at my private loan, let me look at my federal Parent Plus loan and decide which one is best. Now, the first thing we think about is, okay, what are the terms of the private loan, right? And unfortunately, there's not a number I can put on the slide and say, this is the interest rate, this is the origination fee, and that's, it just doesn't work that way. For private loans, you have to submit an application. And what makes it even more complicated is every lender is going to give you a different interest rate, right? Now, most of the lenders, I want to say virtually all lenders don't have an origination fee. There are some lenders out there usually catering to like, international students, sometimes US students without a cosigner that may have origination fees, but by and large, most of them do not have origination fees. So really you're looking at the interest rate, and the borrowing caps are similar. Now, again, it can differ lender to lender. Some lenders will say things like the maximum you can borrow across all of your years is 250,000, right? And that's the actual number. Like it's usually pretty large if they have a borrowing cap. For all
So, Nikhil, sorry, just to interrupt. There was a person who I actually told them to send an email separately, but I was surprised that they had said that the lender that they were working with, they'd already run into the borrowing cap, which was 100K, which I was a little surprised. I mean, it's still a lot to borrow, but I was surprised that the borrowing cap
That's
was
low.
100K. I thought it was low too. So interesting that you said it's usually around 250, because that makes a lot more sense.
I have seen 100K with again the international focused lenders who are, that's just different, yeah, very high interest rates. These are folks who just can't get a loan anywhere else, and then, you know, I don't want to call them predatory, right? But like it's not the typical student lenders we speak of.
Well, I will name the lender because this person wrote it in the chat, which was public to everybody. It was Citizens Bank, which I'm very surprised at.
That is shocking.
Yeah.
I could swear I know people who've taken loans from Citizens Bank more than 100K.
I agree. So the person who
Yeah.
wrote that, so please email us separately and we'll
Yeah, there might be something unique going on over here. It feels odd.
yeah,
So
yeah,
it is Citizens is a big lender. They do a lot of loans.
exactly.
Oh, Citizens. Citizens, not to get into like lender goss, right? But I believe Citizens is the bank. I don't want to don't quote me on this, but I think Citizens is the bank going through a change this year. And the folks who were managing their loan program recently changed. They launched
Oh.
their own product, and I don't know what they did with Citizens. So it could be a result of this, that this is sort of new this year kind of information where this cap is coming into play. I'm going to reach out to a few folks to understand that better. But yeah, this is news to me. Fresh, July 9th. Hey, we learn something every day. Okay, so yeah, so because that interest rate varies lender to lender, things like the borrowing cap also, every lender is setting their own policies. So we kind of have to shop around and compare. And we'll talk about what Juno does to help in this whole very confusing situation. But generally, the thought is if you have a strong credit score and you have a decent debt to income ratio, you might be able to get loans that are more affordable from an interest rate perspective than the Parent Plus loans offered by the government, right? Because the government is saying, here's the number, everyone gets the same number, right? And the private market is saying, hey, you look like you're very likely to pay back this loan. I can give you a lower interest rate, right? So that's really what's happening here. One of the big things you need to consider, though, is hardship protection, right? We spoke about the federal loans having some things like the income-based repayment plans or public service loan forgiveness. That really doesn't exist in the private loan market, right? And because of that, it's sort of even if you qualify if you don't qualify for a better rate, there's pretty much no reason to take a private loan. If you do qualify for a better rate, then you want to make sure you don't need those hardship protections, so you don't value them enough, right? And then it makes sense to use a private loan. What I will say is on hardship protection, it's with the federal government, right? It's a matter of right. You have the right to sign up for an income-based repayment plan, for example. With the private loans, you don't have that right, but once the lender has given you the loan, it's not like they benefit by you defaulting, right? So for example, a member reached out to me. This is after they had graduated, and they said, hey, I have a very low paying job. I'm passionate about this job. I want to stay in this job. What can I do about my loans? And they had, I think, $150,000 of loans. And I said, hey, contact the lenders. They contacted the lender. The lender replied, we can give you 12 months of forbearance and we can give you 24 months of interest-only payments, right? And those were the options that she was able to utilize to manage her situation while she had lower income, right? So it's not that private loans won't play ball per se, right? But it's not a matter of right. You have to reach out to the lender, you have to apply for it, and they can choose to say yes or no, right? Okay. So quick Q&A on the private loan side. When should you think about a private loan? Use the federal loan for the federal direct loan that's directly in your child's name, right? And then sort of weigh the pros and cons between the Parent Plus loan and a private loan. Two of the top and pretty much the only reasons we see people using a private loan sensibly. Some people just sort of click and try to get stuff done, and they use a private loan even when it's not the best option for them. But folks who are thinking through it, it's either because they want the loan to be in their child's name, right? Or two, if they want, if they're qualifying for better rates and they want to take advantage of that and don't need the protections offered by the Parent Plus loan. Okay. How to get the lowest rates? Yes, this is something I have basically built my career around. So let's very passionate about this topic. Shall we take a few questions and then oh, this is interesting. Can you post the real Sallie Mae website so people don't get duped by Google? Okay.
Yeah, I hadn't seen that, other than, I'm guessing maybe what's happening is that lenders are bidding against
Yeah.
the keyword Sallie Mae. And so they might be trying to redirect you to their site.
One common myth, I guess, Sallie Mae is not the federal loans. I know the name makes it feel like Fannie Mae, Freddie Mae, Mac, Sallie Mae, but it's not. There's some history over there on where Sallie Mae was born out of, but as of today, you do not get your federal loans from Sallie Mae. Sallie Mae is just like any other private lender. They're giving you private loans, and none of the federal protections apply when you get a loan from Sallie Mae today. So just be careful that you're not mistaking, FAFSA and federal loans with Sallie Mae. Those are two completely different things. Not to say they're a bad lender, Sallie Mae's, many people use them, totally fine. But just, yeah, they're not the government. Okay. Cool. So Juno, who's Juno? So we've given you a little bit of a landscape, right? And it's like, okay, where does Juno fit into all this? Why do you even exist? That's actually a question I got once from a talk I was giving. So why does Juno exist? Juno is here to help negotiate an option that's better than what you could get going directly to the lenders. That's what we make our mission to be. And really what we want to do is make sure it's the best option, right? And I'll highlight how we've made that possible. We rely on something called a rate match program to make sure that even in the cases where we are not the best option right at the get-go, we can make it the best option. And we're thinking through that from a private student loan perspective. Unfortunately, we haven't been able to replicate the hardship protection features of the Parent Plus. But if a private student loan is potentially attractive, then it's hard to find a better option than Juno. So this is how it works, right? And this is a deal that's live right now. You can use, I think Debbie has a link that she can post in the chat. That's the best link to use, and we should probably update that before we send out these slides. But using that link gets you 2% cash back on your student loan. So let's say you borrow $20,000, 2% of that, if I'm doing my math right, $400 is what you get as, oh, right there, $400 on a 20K loan. Wow. As cash back. And then we back it up with the rate match guarantee, right? So what we say is, hey, we actually encourage you, go shop around, try all the different lenders and see if you can get a better rate than what we are able to get for you. And if you're able to get a better rate, great. Bring that document to us showing that you got a better rate somewhere else. We'll get our lender to match that rate, and we'll send you an additional 1%, a total of 3% for you. This is exclusively for undergraduate student loans. We can't do this for graduate student loans or other types of loans, but for undergraduate student loans, this is what we do. So we try to make the process as simple as possible. This is what we encourage you to do. There's a website called credible.com. And why we like this website is it does a soft credit check, so it doesn't impact your credit report. And through that soft credit check, it'll give you the rates across a wide range of lenders. And so now you sort of see the rates across a variety of places. Then you come to the link Debbie is sharing, and through that link, you check your rates with Juno, right? And now you're comparing. You're like, okay, with Juno, what am I getting? Through all of these lenders on credible.com, what am I getting, right? And if you see that Juno has given you your best option, which we negotiate to make that the case, move forward with that. We're excited for you to have gotten that rate, and you're going to get 2% cash back on top of it. However, if you saw a better rate on Credible, send us a quick email, hello@joinjuno.com. We'll help you get the documentation. We literally sit on one-on-one calls with you, screen share to get everything done. And we'll essentially get the lender on our side to match the same rates you got with whichever other lender. On top of that, we'll make the cash back 3% instead of 2%, right? So you'll get an additional 1% of the loan amount through the rate match process. Yeah, so that's the rate match. And again, Juno is not a lender ourselves, right? We have no incentive to charge you a higher interest rate and make more money. We align our incentives with our members, which are students and families, right? And folks like Debbie who help get the word out about Juno. And our goal is to get you the most affordable option. So I see a question from likely a Juno member saying, what is Earnest? Earnest is a lender. Earnest is a lender that has partnered with Juno, and through them, we are able to provide this cash back, the rate match. Now, these are not features you would get if you go directly to Earnest. You have to come through Juno, and then when Juno directs you into Earnest, that's when you get all of these benefits that don't exist if you go directly to it. So that's what I mean when we say, we are even better than the lender itself, which is kind of weird, right? Like usually if there's someone in the middle, it's going to be worse, right? Because there's someone in the middle. But we've been able to negotiate with the lender so that when you go through Juno, you actually get better rates, terms, cashback, rate match features than what you would get going directly to the lender. Is Juno customer service based in the US? Yes. So on the team is we have someone in Colorado, we have someone in Miami. I'm based out of Boston. Chris is one leg in LA, one leg in Boston. Yes, largely across, we are spread out through the US.
Actually, Nikhil, do you mind if I give a little bit of background, which I mean, so for those of you who don't know, I actually worked in financial services, not in financial aid, but so I've always been interested in making sure that families can get understand their finances and kind of do the proper research for financial products. And when Chris actually came to me, it's probably been about 4 years to explain what Juno did. I thought it was very interesting, and why I thought it was particularly interesting is because as with so many decisions, and particularly financial products decisions, people really need to shop around, you need to research, and you need to compare. And and Juno kind of, with what they were doing, gave the perfect opportunity for people to do that shopping, of rates, which is perfectly fine. It's the exact behavior that I would encourage any and everyone to do if you have to get a loan. And actually, I'm kind of maybe answering a few questions that have come up. There's been a question about, if I get if I apply to a lender, will it hurt my credit score? And what's the process about applying, in a certain time period? So there's something in, Nikhil mentioned a soft pull versus a hard pull. A soft credit pull is in the lender looks at some of your information, but they don't get all of your information. And what they're able to do with the information they get back from the credit bureau is they usually narrow the range at which that they will offer you a rate. So they won't tell you an exact rate, but they will say if their normal range is 4% to 15%, they might say you're likely to get between 4 and 8. So they kind of narrow it down. A hard credit pull is when you apply, you actually give them permission to to get all the information that they want from the credit bureau. And once they do a hard credit pull, the lenders have particular steps and regulations that they need to follow, and they need to then actually give you an interest rate offer, or they need to explain why you might be denied. So and when you do a hard credit pull, usually that first time there is a slight impact to your credit score, because you basically are telling the lending community, I'm looking for a loan and my probably my debt's going to increase. But it's usually just that first time that you do the hard credit pull that there's a minor impact to your credit score, because the credit bureaus know, and they want to encourage people to shop around. So they know that if you're applied for a loan, that hopefully you should be applying at multiple places, and they don't want to discourage that. So they don't want every time you apply to a new loan that within a certain time period that your credit score is impacted. So it's about a 30-day window of when you apply for your first hard credit pull, or your first application to a lender. You have about 30 days to apply to as many other lenders as you want to get the exact interest rate that they will offer you. I encourage people to do that, because as a lot of what Nikhil went through tonight, I can't tell you what interest rate the lender is going to offer you. First of all, I don't necessarily know your credit score. I don't know all your financial history. I also don't know the lender's algorithms. They have their own ways of doing formulas, and they keep that private. So you will definitely see a range. Some lenders can be more aggressive. It also depends on the lender's financial situation. What rate are they able to get their money at that they can lend out to borrowers? So there's a lot of factors involved. And so at a minimum, I would recommend that people go to 3 lenders. If you want to go to more, that's fine. Or you can go to Credible, which is a marketplace, and you kind of fill in your information once, and they will give you rates from a few different lenders. But I would get that information, and then 2 things: you compare whatever the interest rates are that you've gathered against the Parent Plus loan, because if all your interest rates are higher than the Parent Plus loan, then honestly, the Parent Plus loan is probably your best deal, because there could be other reasons why you want to take a private loan, but that's probably going to be where you end up with the Parent Plus loan. But if you're anywhere close to the Parent Plus loan, or a little bit less, and now you have these multiple loans, your next step after getting all the interest rates is to show them to Juno and basically say, let them figure out, which in a lot of cases they can they get you a better rate, or will they do the match that Nikhil just described? And there's no harm in all this. You might just end up with a better deal, and it just takes a little bit of time.
Yeah, and I really want to stress that, right? The shopping around is something, it's so funny when we speak to lenders, right?
Lenders
They
don't want to tell you this.
yeah, they don't want to tell you. They're like, sign now, as soon as you
Right,
apply,
right.
sign now, sign now, sign, ignore all those emails, right? What you want to do is take the time to shop around. And then, yeah, we definitely appreciate folks coming to us using the rate match process. And what you'll find at Juno, right, is we've aligned, like, it's no skin off Juno's back to do the rate match, right? Like, Juno is responsible for sending you that check of 1%. But on the back end, we are charging the lender that 1%. Okay. So when you are talking to someone at Juno, their incentives are fully aligned with yours to make you get that rate match, right? Then, and we're going to try everything under the sun to make sure. And I saw a comment over here, Kerry, someone was not able to get a rate match. Candidly, it's relatively rare for that to happen. The Juno rate match program is more flexible than even the lender's own rate match program. So the lender might have a rate match program, and in our contract with the lender, we require them to have a broader eligibility criteria than what the lender might have themselves. The one situation that we see the rate match program not working out is when someone is trying to borrow funds at a schedule the lender has determined they can't pay back at, right? And for example, that's usually something like someone trying to borrow on a repayment plan that's like immediate repayment plan with, on a 5-year loan term or a 7-year loan term where the monthly payments are quite high, but the debt to income ratio is not supporting that. In that situation, the lender may not do a rate match, right? And obviously, I understand that's a subjective thing where the lender is trying to do some kind of calculation, whereas the honest situation in your household and whether you can afford those payments. So that's one situation I've commonly seen. Otherwise, it's like really one-off kind of weird situations that may come up.
So, Nikhil, there's a question about how did somebody show their offers to Juno?
There is the government has helped us out here. So there is a document called an approval disclosure document, and this document, all the lenders are required to give it to you. So there's no private lender out there that's not going to have this document. And the beauty of this document is we can compare things apples to apples right next to each other, right? So that's what we ask for, right? We ask you to give us the approval disclosure document. We have very detailed instructions for pretty much all the lenders out there on where to find that approval disclosure document on their website. And then you just give us the document, we get our lender to match that and get you the 3% cashback. The whole process, like, it takes more time for me to talk about it than it actually takes, right? And like I said, we are happy to hop on Zoom calls where someone on my team or myself will chat with you one-on-one, we'll screen share, get you that document, and submit the rate match request. Usually 24 to 48 hours, we'll be able to get the rate match processed and you're off to the races.
So somebody mentioned that they sound a little upset. They said they just signed with Sallie Mae and they didn't realize that Sallie Mae was a private lender. They thought it was a federal government agency. But let me just explain for anybody who you might have signed with any other lender. You can still back out of the loan up until the time that the money is dispersed. So, most likely the money has not been dispersed because that's not going to happen until close to the first day of school. But so even though you have signed on the loan, you do not have to go through with it. So for the person who signed with Sallie Mae, it's not a done deal. For anybody else who may have signed because they didn't know about the process that we described tonight, or they didn't know that they could go to Juno, it's not a done deal. So I would encourage you to still share whatever rate you found that was the best with Juno and see what they can do.
I see a few questions here about Juno's. How does Juno make money? What's our fees, etc. we don't have any fees whatsoever that we charge parents. We make our money by charging the lenders. And the way we do this is through our auction process, right? So essentially, it's roughly an annual process for student loans. We have other products where the frequency is a little bit different. And we will broadcast to the lenders a below market fee, right? So there's a lot of, take NerdWallet, LendingTree, all kinds of places that send customers to lenders. We'll pick a rate below market and send that to the lenders and say, hey, this is what Juno is charging this year. And then we invite them to compete for, sort of our collective business, right? And that's when things like this 2% cash back, the rate match guarantee, and those kind of things are negotiated to put something in front of our members. And all of the lenders realize that the only way that they can win Juno's business is essentially offering you the best rates and terms on a collective basis, right? Obviously, on an individual basis, some things get haywire, and that's why the rate match program serves as that bucket to make sure, even if you don't get the best rate from Juno's partnering, well, lights went off. Juno's partnering lender right off the bat, the rate match program is there to make sure that even then it's your best option. It should be very rare for someone to have a better option outside of Juno.
A few more things. Somebody mentioned they have a 2025 high school graduate. Well, first of all, thank you for being here and learning about this process, because I always try and get families with younger students in high school to come, but just because I think it's important to know what the whole borrowing process is, even as you're going through the admissions process, but it's hard to get them here. So I'm glad you're here. And if you have a graduate for 2025, absorb the information you heard tonight, but you won't even be able to really do anything about loans until honestly next year around this time. So, but you'll be at least ahead of the game by understanding what you need to do and potentially factoring in some of this information to your search process.
Couple of questions here. One around timing, if you haven't received a bill. So it's up to you, I would say. Most people start the process once they receive the bill. That being said, you can overestimate the loan amount, and the school will automatically adjust it down to the cost of attendance minus other aid, right? And that's a popular strategy when interest rates are in flux, and it might not be a bad idea right now, right? Knowing what I know, I would say it might not be a bad idea right now. And to echo Debbie's point, right? Look, if you have a loan, and let's say it has a 5%, 5% is crazy in this environment, but let's say you have a 7.5% interest rate, right? And tomorrow you hear, oh, interest rates are coming down. So you go on the website and you check your rate again, and now it's 7% with the same lender. I'm not even talking about a different lender. That's fine, as long as the loan hasn't dispersed. Hey, cancel my first loan. Hey, I want to take the second loan. Boom, you're good to go. But obviously the flip side is not true, right? If you check your rates today, but you don't sign that loan, and then like 2 months later, you come back, rates have gone higher, you can't be like, hey, I want yesterday's rates. It doesn't work that way. So in some ways, by sort of going through the process, as soon as you're able to, you're locking in a rate that can only get better if, circumstances improve. So yeah, we do suggest doing it 1 year at a time. So there's a question here about, do we do the loan amount for the year or semester? Interest is charged based on when the loan is dispersed. The school is automatically going to split up the disbursements by semester. So even though there's this like myth out there that, oh, by applying by semester, you somehow save money, that's really not the case, because interest only accrues on amounts that have actually been dispersed, and the school is already going to split it up by semester. So yep, apply for 1 year at a time. And also, you can't apply for 2 years at a time or 3 years at a time. It just, the whole system is not set up to work that way.
The only other comment I want to make is if you are applying to multiple lenders to kind of, get different rates, make sure that you're doing an apples to apples comparison. And so what I mean by that is that when you apply or and you have to ask for, or it might actually be when you accept the loan, but make sure you're comparing the loan with the same term length of how long you're going to pay it back, that you're comparing how quickly you're going to end up starting the payments. So these are all like the features of the loan, and you just want to make sure you're comparing the same type of loan with the same features across different lenders.
Yeah, the three things I look for is loan term, so 5, 7, 10, 15 years, repayment plan, so when, how much are you paying while you're in school, how much are you paying after graduation, and then finally the rate type, fixed or variable. A good question here, I want to make sure I clarify this because I don't want to give people the wrong impression. If interest rates get better in December, can I refinance, repay the old loan and take a new one? Oof, that's a tough question. So theoretically, the lender you take the loan from has no problem with you refinancing, right? From their perspective, it's a prepayment and there's no prepayment penalties. So that lender does not care. Now, finding a lender that's going to give you this new loan, to refinance your old loan is a little bit more challenging until your student has graduated, right? We see this all the time for folks who have graduated. In fact, Juno negotiates a deal to help you refinance into a lower rate once the student has graduated. Prior to graduation, we just don't see it that much. And each lender is going to have eligibility criteria around this, and one of those criteria just might be, the student needs to be graduated. And oftentimes, the refinancing is not something that can be done with a cosigner. It's often done just as the student or just as the parent. And again, in those situations, it's a bit, if you're doing it with the student in mind, the student doesn't yet have the income or the creditworthiness to be able to qualify for that refinancing. So the original lender has no problems with you refinancing, but finding a lender to do that refinance is more challenging. But what me and Debbie were talking about earlier is prior to disbursement, it's as if there is no loan, right? It's not refinancing, there is no loan. You're just saying, I don't want that loan, I want this loan. So that's a bit different.
So Nikhil, there's a question, I don't know if you have an opinion about this, how people should look at and decide between fixed versus variable interest rates.
I do have an opinion about it. It's a complicated one though. So there's something called a forward curve, right? And you can look at these curves and try to predict how variable rates are going to change in the near future or in the long-term future, etc. But the problem is it's a prediction, it's not a guarantee, right? In fact, Juno used to have this calculator where we would allow you to run the numbers as if the prediction came true, right? And then what we realized was this is a horrible idea because people were making decisions as if the prediction was guaranteed to come true, right? And the prediction is actually more often wrong than right. Like, for example, for I don't know, a decade plus, everyone was projecting rates would go up in a very short time frame. And for a decade, they did not, right? So if you use that calculator to make these decisions, you would have been wrong most of the times. The second thing I'll say is the lenders are smarter than us, right?
They factored it in.
They factored it in. So when right now, a lot of times your variable rate is actually going to be starting out higher than your fixed rate because there's expectations that rates are going to come down. So generally speaking, I can't make a recommendation as to what you should do, but financial advice and legal disclaimers, all of that. But it's uncommon to see someone take a variable rate loan in the current environment.
Yeah. The other reason why a lot of people go with fixed is, as the name implies, you know what your payment's going to be, after graduation. So it's just a variable. If things truly change, your rate could be your payment could be one amount 1 month and could be a different amount another month, or a few months down the road. So it just fixed gives you predictability about what your payments are going to be.
Absolutely. I see a question here about refinancing a parent plus loan in the student's name later. Extremely unlikely because the parent plus loan is only in the parent's name. I'm trying to think if I know of a lender who does that. Debbie, do you know any lender that will refinance a parent plus loan into a student's name?
Not only into a student's name. I mean, what you might be able to do is if you want to move it to a private co-signed
Co-signed,
loan,
yeah.
then that's a possibility. But I don't think I've ever seen a lender that would go from a parent plus loan to a loan that's just in the student's name.
Yeah, and even the co-signed ones are fewer than, usually the refinancing ones are just in one person's name. So it's going to be harder to find someone to do that. Yeah. Studentaid.gov. There's a question here about finding hardship protection information. You want to go to the income-based repayment plans tab on the studentaid.gov website, and that's the best resource. It's a little bit dense on reading, to be honest, but it's usually where I point folks to for understanding those protections, qualifying, how to qualify for those protections, what those protections actually are, because a lot of times, there have been some new changes that improve this, but unfortunately, I won't say unfortunately or fortunately, but fact is they might be challenged in courts, etc. So there's really no information that me or Debbie could give you with certainty on what will happen with those repayment plans. But there's this myth that a lot of people have, like, oh, I don't pay interest, or I'm not accruing any interest during, when you sign up for these income-driven repayment plans. And yes, there is a new repayment plan where that feature has very recently come into existence. But for the vast majority of those options, interest is still accruing, right? It's just about you paying that later, or maybe it being forgiven due to something. But if you go look at your loan balance every month, it's going to be going up, right? And sometimes you hear in the news folks like, oh, I borrowed $30,000 and today, even after 20 years of payments, I have $60,000 in loans, right? That's what's happening. The interest is accruing every month. So just be careful and make sure you understand the benefits you're using. A lot of them are to help you manage your life as you go through a period of low income. Not all of these benefits are set up to wipe out the debt.
So Nikhil, I don't know how much you guys deal with or know about the PSLF and Parent Plus loans. There's been a few questions.
Yeah, we generally, we are more experts on the private student loan side. What again, we sort of redirect to the studentaid.gov website for the public service loan forgiveness. And again, we caution to make sure you are, there have been some startups come out over the years to help you stay on track for that forgiveness, because you have to meet the requirements for X number of months, make those payments for X number of months. And if you sort of drop the ball along the way, you might not qualify, right? So it's something you really want to think about. For example, I was speaking to a law student the other day, and they were doing a clerkship, and that was helping them qualify. And then at some point, they took a job in the private sector, and they didn't realize that, that's it. It's not like there's some accrual of benefit or something like that. They no longer qualify. And they kind of didn't realize how of the big financial decision they made by taking that job and leaving the clerkship.
Yeah.
So,
If you do have questions about, if you work in public service, we actually get a lot of questions about teachers. Email me at support@rhodecollege.com. We actually have somebody who is pretty knowledgeable about PSLF, but kind of what Nikhil mentioned, she will understand your situation and really explain the program to you so that you know all the implications about how long it's going to take and what you need to follow through on to make it really worthwhile. It can be really worthwhile, but it's a 10-year commitment. So you just need to understand what's involved.
There's a great question here about deferring loans. Can you make interest payments? Yes. So as soon as the servicing portal is set up, which usually happens after the first disbursement occurs, right? Give it a few weeks, but a few weeks after the first disbursement occurs. At that point, you can log into the services website and start making payments, interest payments, full payments, partial payments, whatever you want. You can start making payments towards the loans.
So how about maybe as like a last comment to just explain a little bit what you just said. I don't think that people understand or know what happens when their student, or even if they take out the Parent Plus loan, like who the servicer is, what that means, and where they like really find that information out.
That is a great question. So the servicer, I think of the servicer really as the place where my relationship with the loan is managed, right? And oftentimes, even if it's a federal loan, it could be a private company that is given the responsibility of servicing your loan. So they're the ones, you log into their website if you want to see what's my balance, or if you want to see the statements of
So it still is
history of the loan.
a federal loan, but the government has contracted with private companies to manage, as Nikhil mentioned, manage the statements to you, the monitoring of your account, the tracking of interest, your payments. That is usually given to a private company to manage on behalf of the government.
Even some of these benefits, like the income-driven protection plans, etc., like enrolling in those often happen, not often, it almost always happens through the servicer. So this is the place where you would get the form to fill out to say, hey, I want to enroll in this. It could be a digital form, it could be like a PDF, but that's, your relationship with the loan goes through the servicer, and most importantly, your payments, right? Like many people set up automatic payments. This is the website where you would go to set up automatic payments, and then every month, the money would be poured from your account, or one-time payments if you want to do that instead.
So somebody's asking, if you defer the Parent Plus loan until after graduation, can you start paying interest right away?
After disbursement, yes, you
Yes.
can start paying the interest. One minor optimization I might point out, right? Interest on student loans is simple interest until 6 months after graduation, if you're choosing the deferment, which means unless you're actually paying off some of the principal, there's no real benefit to paying off the interest every month until 6 months after graduation. There's 100% after the 6 months after graduation, it's compounding. So at that point, you should very much be making those payments. But before that, you might be better off just saving that money in like a high yield savings account or somewhere safe, right? And then a couple of months around graduation, you log in and make a bulk payment. The impact of that is going to be better than the impact of making interest only payments each month. Just a very nuanced point is just because the interest that accrues prior to the 6-month point after graduation is based on a simple interest formula and not a compounding interest formula. So, again, might be something you want to check with your servicer, make sure that every servicer, I'm pretty sure every servicer does it this way, but, check with the servicer. But if they're charging simple interest up to the point of 6 months after graduation, then you may want to just save that money in a savings account or something like that, a fixed deposit, and then right around graduation, log into the lender's portal, put that money to work, and it's going to have a better overall monetary impact than paying each month.
Okay, last question, and it's a good one about should parents consider refinancing their home as the way to pay for college as opposed to taking out Parent Plus loans?
So many things to consider on that one. Oof. Um, I don't know. I don't know how to answer that question.
Well, I will throw out, well, first of all, if you refinance again, that's, you are still the borrower, you as the parent. So it doesn't give you a chance to share that loan with your student in terms of responsibility. The second is you are, I mean, a little bit putting your home at more risk. And if something happens to your finances, your job, there's not protections in place as there are with the student loans. So it's really kind of a risk analysis, I think, in that you're just taking on more of the risk as opposed to sharing it with your student.
Yeah. There's also, interest rate right now on home loans, and especially if you're going for like a HELOC or something like that, right? Let's say you have like a 4.5%, 5% on your home loan, and you end up refinancing it, you might end up at like a 6.5% on the entire balance, right? That might be more expensive than 8% on just the student loan amount. So that's one thing to get. Second thing is you can't, it's very hard to refinance a house every year, right? Because there are transaction costs involved with doing that. So you might end up borrowing a lot in your first year, and now you're paying interest for it over 4 years, when with the student loan, you only get taxed, you only pay the interest as the funds get dispersed, right? There is a taxation benefit. I just said the word tax, and so I remembered. Oftentimes, the student is not making a lot of income that allows them to qualify for essentially the interest on the student loan being tax-free, right, when they start repaying it. And the parent may be in an income bracket where that would get taxed. So there's a potential tax difference over there. Yeah. And finally, if you're thinking the HELOC route, that's a different discussion, but oftentimes we find the interest rate on a HELOC is actually sometimes worse than a student loan. So yeah, the more I think about it, I don't love the idea, but there might be some unique situations where it makes sense.
Okay, very, very last, somebody is asking if you can explain again why it would make sense, why it doesn't make sense to pay interest on the loans while they're in school and kind of save it till.
Yeah, it's such a nuanced point. So if I am the servicer, right, and I'm calculating your interest, let's say I'm in month 1, your loan balance is, call it $10,000, and your interest rate, just for easy math, is 12%. Okay, so per month 1%. The interest that I'm going to add to your account in month 1 is 10,000 into 1%, $100. So at the end of month 1, your balance is 10,100. Now in month 2, if we were doing compounding, I would do 10,100 into 1%. But we're not doing compounding, we're doing simple interest. So I'm still going to use 10,000, not 10,100. And because of that, the next month, my interest addition is only $100 instead of $101. And this goes on every month, of course. And therefore, at the end of, let's say, 24 months or 48 months, right? Let's say you have 100 into 48 months worth of interest accrued. You can simply log in and pay that off. Meanwhile, for those 48 months, if your money was sitting in a, let's say, what's this called? A high yield savings account earning you 5%, your money has now grown, over 4 years, like 20%, and you can apply, and by the way, that's compounding, that's not simple interest, right? So maybe like 20-25%, and now you can take all of that, pay off the interest that's accrued over the 48 months, and your balance, even though the amount that you put into that savings account might be, $100 each month into 48 months, because of the interest you gained on that savings account, it's going to be a larger amount, and you're going to pay off more of the balance on your student loan. Now, as soon as the loan starts compounding, all of this doesn't apply. But while it's in simple interest, this applies, and you get, so it's kind of a weird point. You almost have to see it on a spreadsheet for me to fully communicate it. But yeah, it's just that your savings account will compound, your interest is not compounding, and therefore.
So it's just the difference between the rate of interest compounding.
Yeah.
Okay, well, thank you, Nikhil. I think this was extremely helpful for parents here. We do send out the recording tomorrow, and it will have a link to this, and we'll have more links to sign up for Juno. And I know from working with Nikhil and Chris over the past few years that they are extremely generous in answering any questions you have, and to call or email their team, and they will help as best that they can.
Absolutely.
Okay, well, thank you, everyone. And reach out with questions. The next few weeks is the time to settle this all, and then hopefully, do your last bit of dorm shopping, and you can, some people may enjoy it, some people may not enjoy it, but bringing your child to college, it will shortly happen over the next 6 to 8 weeks. Okay.
Moment.
Thank you, everyone. Good night.